This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachurdes. Thanks for joining us at XM.com. The prospect of another round of economic sanctions against Moscow is back on the table following reports of atrocities against civilians in Ukraine. The U.S. Treasury has already made its move, cutting off the Russian government from using its frozen U.S. dollar reserves for making coupon payments on bonds. This means Moscow must now drain the foreign currency revenue it earns from exports to make coupon payments, or make them in rubles, which would correspond to a technical default. Either way, the aim is to cripple the war effort. The ball is now in Europe's court, with pressure growing to impose a total energy embargo. Economically speaking, this is the nuclear option, as a sudden ban on energy products could inflict more damage on the European economy than on the Russian one. It is therefore unlikely to happen, but nevertheless, the mere discussion was enough to breathe life back into oil prices and deal another blow to the euro. It's difficult to be optimistic about the euro these days. Hopes for an imminent peace deal have been squashed by the alleged war crimes. The economy is flirting with a recession, and the ECB's hands are tied by surging inflation. Elsewhere, oil prices have been enjoying the show, rising on hopes for an embargo on Russian energy and the inability of negotiators to seal the Iran deal. The striking part is that traders seem entirely preoccupied with the supply side of the equation, paying little attention to the expanding lockdowns in China that threaten to dampen demand. The Reserve Bank of Australia injected new life into the Aussie today after it dropped its reference to being patient and essentially opened the door for a rate increase soon. In equity markets, the tech complex spearheaded another powerful rally, with Twitter leading the charge after Elon Musk announced he had taken a 9.2% stake in the company. The real show will begin next week when the earnings season kicks off with the big banks. Investors will be looking at the damage from the sanctions and rising energy costs to gauge the fallout on economic growth and corporate earnings. This is today's Daily Market Comment. Thanks for joining us at XM.com.